What's up guys, Rosario here, and today I've got an exciting video for you. We're going to be talking about whether you should rent your place or buy your place. I'm going to be using my home as a specific example. We're trying to decide right now, okay, should we keep renting or should we buy? This example applies to downtown Vancouver, but you can actually take my spreadsheet, which is pasted in the link below, take a look at it, punch in the numbers for your area or for the house that you want to buy or rent, and get your answer as well. So let's dive right in. This is my condo. This is my condo in downtown Vancouver. This is where I'm renting right now. I'm gonna blur out the address there. Just so we don't get any creepy stalkers. That's okay. I trust you guys. It's gonna be all right. So it's a 1,322 square foot apartment in the heart of downtown Vancouver. We have our beautiful dog and cat in the apartment as well. And it's a 2-bed, 2-bath. We've got lots of utilities and a fitness center, which unfortunately we can't use right now because of certain world circumstances. And the rent is $39.65 per month. Actually, we're not paying that. We're only paying $3,700 a month because we got a really good deal on this place. Okay, so that seems like a lot of money to spend on a 2-bedroom, 2-bathroom apartment, and I totally agree. But wait until you find out how much a similar condo costs to buy up front. That's right. To buy a condo in this exact same building, we're looking at $1.528 million to buy a condo in this building. And this condo is actually smaller than the one that we're renting right now and several floors lower down. Holy crap. So it seems kind of obvious that we might want to rent, right? Well, there's actually some complications here. And I'm going to talk about it. I'm going to dive in depth and show you guys how to decide if you should rent or own and what that's going to do for your money in the future. As always, our goal is to help you grow your wealth and maximize your happiness. So sit back, get some popcorn, get a treat. We'll jump right into the numbers and figure out whether you should rent or whether you should buy. All right, guys, so here's our spreadsheet as usual. And before I get started, I just want to remind you guys to click the link in the description below to get your 10 free dollars with Wealthsimple when you get started today. And that'll allow you to get investing and continue to grow your wealth. Okay, so let's dive right in here. Let's start with the rent versus buy comparison. We'll start on the rent side of things. We're on over the 30th floor in this building. We've got 2 beds, 2 bathrooms, and 1,300 square feet. Our lease term is 12 months. Here we've got our recurring monthly costs. So this is what we're paying every month to rent this place. We're paying $3,700 a month in rent. As I said, you might only be able to get this place for $3,900, but we wanted to give renting a little bit of an advantage here. Then we've got $200 a month in utilities, and that includes internet, electricity, and the ability to charge our electric vehicle in the parking space downstairs. And then we also pay $45 a month in renter's insurance. So that gives us a total of $3,945 per month to rent this apartment. Up front, in terms of cash costs to rent, you have to pay 1 month of rent for your down payment or your damage deposit, and then a pet fee of $300 so that we could have our little guys in the apartment. So that gives us a total of $4,000 upfront to rent. Not too bad. I mean, it's really expensive compared to almost anywhere else in Canada, but we feel like we got a good deal for downtown Vancouver. Now let's get into the buy decision. Let's take a look at the property details. A lot of this information we got directly off MLS. You can check this info for yourself, but the purchase price of this property was $1.528 million. That is that similar property that's slightly smaller than this one, but we're going to use it for a comparable because it's quite close. The annual property taxes are $4,397, $4,400 per year. That might seem a little low to you guys compared to the actual property cost. The reason for that is that, and you can probably see it on the screen here, Vancouver actually has Canada's lowest property tax rate at around 0.2%, whereas the rest of Canada is around 1% or higher. And the reason for that is that property values have exploded so fast here in Vancouver that the government decided to lower the property tax rate to prevent people from losing their homes because they can't afford the property tax. Maintenance and strata fees. So what that is a condo fee essentially. Condos are called stratas in British Columbia. Your condo, in order to fix the building, provide security and facilities, they charge you $532 per month while you're living in the building. Then there's also a provincial land transfer tax, which ends up being about 2% of the purchase price, or $28,000. You have lawyer fees when you go to buy a house of about $1,000. You also have to pay for title insurance, home inspection, and appraisal. So those are kind of the costs that you're looking at for buying a house. But let's try to compare it in a way that's similar to what we're looking at for renting. When you buy, you're probably going to get a mortgage. We would have to get a mortgage unless you have $1.6 million in cash sitting around, which I don't know if a lot of people watching this channel do, but if you do, good for you. Mortgage details. So we're looking at a 25-year amortization period, an interest rate of 2%, and a monthly payment of $5,205. That's right, your mortgage payment is $5,200 a month. That is substantially more than even what we're paying in rent. So that doesn't look good for buying right now. Our down payment, we've put 20%. The reason for that is that's quite a high down payment. I would like to put less down if possible, but unfortunately in Canada, if you are buying a house that's worth more than $1 million, you must put down at least 20%. And that really sucks if you live in a major city where all properties essentially cost more than $1 million. So the amount that we're mortgaging is the purchase price minus the 20% down, or $1.2 million. Let's talk about our recurring monthly costs. So this is kind of what we can compare to our rent. So in terms of our recurring costs for owning the property, we're looking at a mortgage payment of $5,200 per month. Utilities of $200 per month, home insurance $100 per month, property taxes are $366 per month. Our strata fees, as mentioned, $532, and maintenance and repairs of $50 a month. That might seem quite low to you as well. I decided to use that lower number because this is a condo. There's not a lot of maintenance. It's relatively new. That gives us a total of $6,453 per month in costs to own the property. So that is a lot higher than the $4,000 a month that we're paying in monthly costs to rent the property. So right now, it looks like renting is on top. And this is only gonna get worse when we look at the upfront cash costs. So when you buy a house, you have to put that 20% down, but there's also some other costs that you have to pay as well. These you don't really get back. So we've got the down payment amount, which is $305,000. We've got the provincial land transfer tax of $28,000. We've got legal fees of $1,000, title insurance $1,500, home inspection and appraisal, for a total of $337,000 in cash that you have to put up to purchase this condo. If you don't have $340,000 in cash, this is the money that you're gonna have to put up front to get this property. All right, so let's compare renting and buying. So we've got our total monthly costs of $39.45 for renting, and our total monthly costs of $6,400 for owning, and our total upfront costs of $337,000 for owning, and our total upfront cost of $4,000 for renting. So it seems like buying is a not so great decision, especially if you don't have that kind of cash laying around. But let's assume we do. What option should we go with? It kind of seems obvious that renting is better because you're spending less, but is it really? Let's take a look and take a deeper dive in. What we're gonna do is we're gonna look at our opportunity cost. And what your opportunity cost is, okay, if we decide to rent versus own, giving up the opportunity to actually have that property value that increases over time. And if we decide to own versus rent, we're giving up that principal, that down payment, that huge amount of money that we have to put down up front that we could otherwise invest in alternatives. That amount that we have to put down at the front, the amount that you could invest in the market, that's your cost of capital, or actually how much return you're gonna get from that amount is your cost of capital. The way that we calculate this is let's say we're gonna rent, and instead of buying, how much money would we have left over that we could put in the market? So if we're gonna rent, what we do is we take that $337,000 that we'd have to put up to buy, we subtract the $4,000 that we have to put as a damage deposit, and we say that we have $333,488 in cash that we could actually just take and dump into whatever investment that we want. Then we also have the difference in the monthly costs. Owning was $6,400 a month, and renting was about $3,900 a month. If you subtract those two, you'd be left with a monthly cash extra in terms of renting compared to buying of $2,500 that you'd have to pump into the market. How much money could we expect to earn on that money if we decide to invest it? Let's say we're renting, we're going to put that other money into some other investments. Well, the number that I chose was 8%. Your number may vary, but based on long-term interest rates and rates of return for the S&P 500 and for other international and US indices, it's extremely reasonable to get a nominal return rate of 8% on your invested capital. If we take that money and we put it in an S&P 500 index, for example, or in a total market index, or in a diversified portfolio, hopefully we can expect to get about 8% returns in the long run. So then if we calculate using the compound interest formula, how much money we'd have investing that $333,000 at 8%, we'd have almost $720,000 in the bank after 10 years. And after 10 years, if we're putting that $2,500 difference and investing it in the market, we have $460,000 as well. So you add those two together, and that gives us a difference or a total assets in the bank that we could potentially have by renting of $1.18 million. So we'd have $1.18 million in the bank after 10 years if we took that money that we were going to use buying the home and actually take that money and invest it in the market and rent the house instead, or rent the condo instead. So that seems pretty good for renting. We've got all this extra money that we can put in the market and use to grow our wealth. So why would anyone choose to buy? Well, let's do the math on the buy side, because there are some advantages to buying as well. But what is the advantage to buying? So the real advantage to buying is that you have this property that can appreciate in value, and then when you sell it, you can get the difference in the amount of money that you bought it for versus how much you sold it for. But in order to figure out how much you're actually making here, we need to do a few things. The first thing is we need to figure out, okay, how much are we paying on our mortgage? That's pretty simple. After 10 years, we just go 10 times 12 payments per year, times the amount that you're paying on your mortgage, which is $5,200 a month, and you get $624,000 paid towards your mortgage. But that is not all going towards your principal. As part of that mortgage payment, you're paying interest. And so you can use the cumulative interest payment function on Excel to calculate your interest cost, which turns out to be $183,000. So if you subtract those two numbers, we wind up with $440,000 of our mortgage being paid down after 10 years, which leaves us with a home equity of about $750,000, because we have that down payment that we paid added to the mortgage that we've paid down, leaves us with about $750,000 in home equity. If the market continues to appreciate at the rates that it has been, or that we expect it to appreciate at, historical world market averages for real estate are about 1.9% real rate of return plus about 2% inflation, which is about 3.9% average rate of return over the last 100 years or so. I said that we'd get about 3.5% nominal. It's a bit conservative. You might raise that up a little bit or lower it depending on what you think is going to happen in the real estate market. But I think 3.5% is a good number here. That leaves us with a condo property value of $2.16 million after only 10 years. That's quite a big increase. So in 10 years from now, we should be able to sell this place for about $2.15 million. If we take the amount of the mortgage and we subtract out how much mortgage we've paid down, we wind up with a remaining principal owing. So this is how much we still owe on the mortgage of $782,000. If we subtract the house value from the remaining principal owing, we end up with total assets of $3.37 million. That's pretty good. We actually have $3.37 million in assets in the bank, $1.37 million of equity that we now have access to after those 10 years in the house. So if you look at these two numbers and you compare them straight up, we can see that after 10 years, it might actually be a better decision to buy the house versus rent it. That was very surprising to me. There are a few other costs that we need to consider. Let me take a couple minutes here and we'll figure out what those are. All right, so we've got our comparison here of total assets at the end, but what if you actually want to, take advantage of that? What if you want to sell your house and go buy another house? Which way are you going to be better off? So we've got some selling costs here. Selling costs are what it costs as the seller to actually get rid of your home. In Vancouver, we're looking at a real estate commission of about 2.5%. So on that selling price of $2.15 million, that comes out to about $60,000. You're also looking to pay GST on that cost. So after the sale of your house, you're ending up with $2.09 million, which gives you net assets after selling of $1.31 million. So actually we're still better off here in terms of the buy-sell decision to buy in terms of net assets after 10 years. But what happens if we change that 10-year number? There's a reason I picked 10 years. So let's say we go for the full amortization period and we just let the house appreciate over 25 years. We will have a difference of $4.7 million in the bank. If we were renting for that long, our net assets after the sale of the house would only be $3.5 million. So at that point, it becomes a way better decision to rent. The reason for the discrepancy in these numbers is that because real estate appreciates at a slower rate compared to the market, over a longer time horizon, you're actually going to do better investing in the market compared to real estate. But let's look at like 3 years, for example. Like let's say we want to buy this house and sell it in only a few years. So we're actually looking at a bit better value owning the house versus renting if you're expecting the market to appreciate over the next few years. Okay, so after all that, where are we? It seems like it might actually be a better decision for us to buy. Although not by very much. It looks like about $150,000 in difference. If our numbers are off slightly in terms of the market rate of return, that's going to end up quite different. There are some other disadvantages because if we have those liquid assets in the market when we're renting and we have our money in the market, that's going to be easy to sell, easy to get out of those positions if we need the money. But if the market crashes, in housing, it's going to be harder for us to, sell our house. It could take quite a long time to sell a property. So you obviously have that advantage of having more liquid assets from renting. In our case, we don't want to put down close to $400,000 upfront to buy. We don't see ourselves living in a condo long term for a number of reasons, not least of which is that we want to have kids at some point, and having more than one kid in a condo could be quite a challenge. These are comparable options, and it was actually surprising to me because I was like, how can anyone justify purchasing a house in Vancouver? But if you look at the changes and the differences in the property tax rate and the differences in maintenance costs of owning a condo, it actually comes out pretty much a wash between renting or buying in the long run in terms of actual assets that you have available at the end. Your situation may vary. I encourage you to check out the link to this spreadsheet, which should be in the description of this video. Enter the numbers for your area. I am going to do another version of this for Victoria because that's another place we're looking at potentially buying. It's also going to depend on what is available to rent versus buy in your area. In conclusion, thanks a lot, guys, for watching. I really hope this was helpful to you. If it was, please like, comment, and subscribe to the channel. It really does help us grow. I'm really excited to make more of these videos, and if it continues to provide value for you guys, that's exactly what I want. Talk to you guys in the next one.